Alright, what's up YouTube? This video is going to be number 3 on the ICT Bootcamp, going over market structure and time-based liquidity. Right here we're on an hourly chart, and I just want you to notice, as far as time-based liquidity, this was the weekly low. And for your notes, when I talk about time-based liquidity, I'm talking about previous week high and low, previous day high and low, previous session high and lows. To me, that's what I'm looking at, like an Asia high, Asia low, a London high, a London low, New York high and low. That's what I mean by session. And usually what I'm going on is the high and low made from 6 p.m. to midnight, and then midnight to 6 a.m. and the morning session, evening session, which you can play around with those times, but this is just an example. We're on an hourly chart. This is last week's low. So if you're waiting on a trade, after we took out last week's low, what did we do on Friday? Did we displace through it, or did we just kind of manipulate it? And what I mean by manipulate versus displacement, meaning manipulate means just take the low and then aggressively move away. Displacement would be take the low and then run through it. Kind of like, we've got these lows here, we manipulate it, then we ran through it. That's going to be manipulation versus displacement. Time-based liquidity is going to be previous week's high and low, like you see here, previous weekly low. We manipulate it, and then we have a strong rebound. So on Friday at 10 o'clock, I would be looking to take that bounce off the VWAP, targeting what? All these relative equal highs right here. All this accumulation, manipulation, distribution on a higher time frame. But market structure, I'm going to go to a 1 minute chart and just kind of show you this is just basic stuff. In a bullish scenario, we should be respecting these fair value gaps. So higher high, so this is the low, then we move up, and we're just making a high, coming down, up, higher high, higher low, higher high, lower low. That would be a good time, to get in when we take out some internal liquidity here. When I say no raid, no trade, this is what I'm talking about. You can take a continuation off a fair value gap, but what I like to see is like internal structure and then a breakdown into a key area, which that's a fair value gap, targeting the highs. Always targeting the highs. That's why I have this indicator on my chart that shows fair value gaps, because if we're bullish, we want to see them respect it. And it gives you your target, it gives you everything. So if you're in this one, you're going to target these equal highs. You're in here, targeting those equal highs. Say you're in here, you want it to at least take out, you want it to make a new high in a bullish scenario, and vice versa. In a bearish leg, you want it to do the same thing. Like here, in a fair value gap, we respect it, make a new low. In a fair value gap, respect it, make a new low. But market structure is just very simple. Is kind of finding the trend. And if you're bullish, you want to see higher highs and lower lows. We'll go on 15 minute and kind of look how that looks. We're going up, we have a retracement, go higher, and vice versa. On a bearish leg, when you see this big impulse down, you want to see it come up, and then you want to see it make a new low. And that's how I use these indicators. That's the only indicator I I use other than VWAP is just you you know, I'm a contrarian trader, but if we're going straight up, I'm not trying to catch a 20-point move on a pullback. I'm going to wait on the pullback, then I'm going to wait for a reaction in that area, and then I'm going to target. Hopefully, it's going to make a new high in a bullish scenario. So to me, price is always going to go from internal to external. That's what that means. Internal being fair value gaps, external meaning it's going to create a new high. That's how the market moves. It moves from internal liquidity to external. Internal being fair value gaps, like right here. This bearish fair value gap, it closes up here, and it makes a fair value gap, a bullish one. That's my favorite setup, is when we have an inversion and then we make a fair value gap going the other way. That's a very high probability setup. So that's internal to external, meaning internal fair value gap, order block, whatever, external swing highs and swing lows. Okay, we went over manipulation versus displacement, meaning we have, go back to the hourly, we've got this low, last week's low. If we're bullish, we want to see that low get swept. We want it to manipulate, meaning we want it to go below it, but then as soon as we do, we don't have a breakout, we go the other way. That's manipulation. Displacement would be back in here where you have, you know, these lows and we aggressively run through them. Like here you have this low, we aggressively run through it. So that's going to be internal versus external, manipulation versus displacement, and basic bullish and bearish market structure, just higher highs, higher lows. And what makes this what makes time-based liquidity so important to me is that gives you your key area. You know, people talking about, you know, your key areas, and you're like, you know, you can draw lines on anywhere and say it's a key area, but your time-based levels are of most importance, meaning weekly highs, weekly lows, previous daily high, previous daily low, session highs, session lows. You want to watch those levels and see how they react. If they displace through them, then we're off to the next one. Say it was a previous session high that gets taken out and we displace through it. Okay, maybe we're looking for a previous daily high then. If we displace through that, then obviously what we're looking at, we're going to go to the weekly high. That's kind of how you see how the market, how you can kind of predict where it's going. If it takes out the session and the daily and we're displacing, we could be heading towards, you know, the weekly high. So that's why time-based liquidity to me is so important, because it tells you the story. It gives you the narrative that you need. And then the market structure, if we're respecting bearish PD arrays, while, like right here, we have a bullish fair value gap, right? And it goes into a bearish PD array. We come down, we close below it. This should be like, okay, we at least should target this low. And after we displace through it, what's the next low? Right here. And that's, what is that low? That's the previous week's low. Okay, did we displace through it? No, we didn't. No, that's not the previous week's low. I'm on a 4-hour time frame, I'm sorry. This would be it. But like right here, this is where we manipulated the low, get everybody saying, okay, we're selling off this big wick. No, not yet. We're going to rebound. So that's how I use time-based liquidity to give me narrative to find directional bias. And that's how I use market structure. It's real simple. I'm just looking at bullish or bearish PD arrays, mainly fair value gaps, Are we respecting them? Are we inverting them? And I do a top down. I'll start at the weekly, see where we're at. Okay, we're nothing really there. Um, you could say that this is a weekly bullish order block, because even though we've wicked down, look at the bodies. The bodies are telling you it's close and above it. So okay, go to the daily, and look, we've disrespected this over here. So when you see that, and then you see a run back up into that area, you should know that you're probably going to get, if it's going to be bearish, we should take off. So this is kind of getting ahead of myself with buys, and how going to try to figure out what direction, whatever session. You can do this by session. It don't have to be by day, but this is how I start at the top. Then I work my way down to the 4 hour, see where we're at. Like right now we're in a bearish PD array, and we're starting to reject. So that was on the 4 hour. So I'll go back up to the daily. Can I make a bearish case? Well, we probably want to see it open and go up into this and see how we react. We could go all the way up here. We could take the top off. I mean, you're not going to be right all the time, but that's how I cycle through, the time frames. I start at the weekly, daily, 4 hour, all the way down to try to find what I'm doing. So market structure, you should not overcomplicate it. It should be higher highs, higher lows. I'll do a more in-depth one with market structure shifts, breaks, all that good stuff. But I'm just trying to keep it simple, because this is exactly what I do. I mark out the time-based levels. I see how we react. Then I get down on the smaller time frames and see how we're reacting. So I hope this helps you. If you have any questions, just leave them in the comments. I'm basically just using time-based levels for key areas to see how we react, and I'm dropping down on smaller time frames and looking at fair value gaps and seeing if they're being inverted or being respected, and using around the VWAP area. Because if you look at VWAP, a lot of big moves, like this big move right here Thursday, right off the VWAP, boom, come back up to it, touch it again, 10-15, real close, boom, we sell off. Same thing over here, we're selling off the VWAP. And then when we go the other way, Friday, right off the VWAP. So that's why I use that, just to kind of give, it's kind of like my midnight open, my barometer. And I'm sorry, my throat is killing me. That's why it took me a few days to make this. But I hope this helped. I appreciate you. God bless you, and good luck trading.